Now it's time for the Taxcast special feature. We forget history and its lessons so quickly. Time and time again, whistleblowers are our most valuable resource. But are we listening to them? Are you sitting comfortably? Once upon a time,
the United States had over 50 years of immense stability in banking with minimal failures, and this was the product of the regulations adopted out of the bitter experience with the Great Depression.
This is William Black, serial whistleblower, former senior US regulator, white-collar criminologist and associate professor of law and economics. That bitter experience with the Great Depression he's talking about led to good, solid legislation that protected the public from the banking sector. Things like the Glass-Steagall Act that separated commercial banking from riskier investment banking. But then this happened.
I have only one thing to say. You turn if you want to. The ladies not for turning.
And this happened.
I would like to have a crusade today to take government off the backs of the great people of this country. Less government and less taxes and more freedom for the people.
Bill Black.
And then they decided that really very substantial deregulation was the answer. And this set the scene for what's now been 30 years of successive crises, starting with the savings and loan debacle, the Enron era scandals, and of course the modern crisis.
The savings and loans scandal in the 1980s was 1/70th the size of the 2008 financial crisis. Just to put that into perspective,
the current crisis is going to cost the nation in lost GDP roughly 160 times more than the savings and loan debacle cost in terms of money from Treasury. So the savings and loan debacle was $150 billion in 1993 dollars. The current crisis is estimated to cost $24.3 trillion by economists. So this is just a spectacularly large number. When the savings and loan debacle started, people assumed that fraud had nothing to do with it. They used very similar language to what they're using now. It was just risk, right? Imprudent risk. People just got wild and crazy. And there were virtually no prosecutions, and there were virtually no serious enforcement actions, certainly not against anybody powerful.
But then Bill Black and his enforcers got busy. We'll have more about that in a minute. Just as with the savings and loan scandal, the 2008 financial crisis was also the result of serial fraud coming from the boardrooms down. Lehman Brothers and other banks were peddling a system of bad loans Bill Black maintains they knew could never be paid back. He calls them liar's loans, basically lending money to people without checking their income and ability to pay it back. Lending so much meant guaranteed record profits in the early years. They borrowed loads of money and grew very fast in what he calls a huge kind of Ponzi scheme. The CEOs got rich. Obviously it couldn't last, but they didn't care, and the government didn't care about stopping them. Here's Bill Black giving testimony to the House Financial Services Committee a few years back.
Lehman was the leading purveyor of liar's loans in the world. Studies on liar's loans show incidence of fraud of 90%. When people cheat, you cannot, as a regulator, continue business as usual. Every day, the exposure of the American people to loss grew by hundreds of millions of dollars on average. All of the major regulatory agencies were complicit. We have a self-fulfilling policy of regulatory failure because of the leadership in this era. Well, what would you do as a regulator if you knew that one of the largest enterprises in the world, when the nation is on the brink of collapse, economic collapse, is engaged in fraud? Would you continue business as usual? That's what was done.
But during his time as a senior regulator, Bill Black certainly did not do business as usual. Despite limitations in terms of staff numbers, political will, he and his team cracked down on banks big time.
We made over 30,000 criminal referrals in just about the key 6 years of the crisis. And that turned out to be what was decisive in changing the FBI and the assistant U.S. attorneys, because we made public how many criminal referrals we had made. And so, pretty soon there were 3,000 criminal referrals and only 2 cases being investigated or prosecuted by the Justice Department. And so reporters started every month to take our latest number and go to the Justice Department and say, okay, it's now up to 4,600 criminal referrals, and there are 4 cases. What in God's name is going on? The Justice Department got sick of being beaten over the head by the media.
So the Justice Department started to prosecute bankers by the hundreds.
They have the best criminal defense lawyers in the world. They will spend money like water to keep the CEO out of prison, especially because typically the bank will pay for that defense. And despite that, we got a 90% conviction rate. Collectively, just in cases designated as major by the Justice Department, we got over 1,000 felony convictions. We got over 800 of them sentenced to prison out of that. So it's the greatest success against elite white-collar criminals in history. And eventually, we had over 3,000 enforcement actions. And these were, unlike the current slap on the wrist, these were really serious things where we were kicking people out of the industry forever. And, of course, we were putting hundreds of institutions in receivership, removing entirely the senior management and putting new, honest people in charge.
The Justice Department started to enjoy all the media attention because they were becoming national heroes for taking on the banks. And that made the politicians look bad.
Politicians rushed to give back their political contributions or to donate them to charity that they got from the worst frauds. And so the thing that had been the savings and loan fraudsters' most important weapon, the political contribution, to get that enormous help from these very senior folks, the politicians, suddenly became a liability. And it helped us because all of this moved the story from being a business story, stuck in the interior of the newspaper where no one read it, where the journalists were business journalists who were very hostile to the government and very positive to the crooks at first, and moved it instead, once the politicians attacked us, to the front pages. And then it was a political story. And it's a political story of, in essence, corruption. Powerful politicians coming after government officials who are simply trying to do their job and prevent these frauds.
But then this happened.
My fellow Americans, this victory was more than a victory of party. It was a victory for the people who work hard and play by the rules. A victory for the people who are ready to compete and win in the global economy, but who need a government that offers a hand up, not a handout. That is what we offer, and that is what tomorrow we will begin to work to provide to all of you.
That's when President Clinton got elected. And President Clinton, of course, came in as the leader of the New Democrats. Any of your listeners who are familiar with New Labor under Tony Blair consciously modeled himself on the New Democrats. And they had a fierce ideological commitment to what we call the 3 Ds: deregulation, desupervision, and de facto decriminalization. So the regulation part, deregulation, everyone knows that, but the far more devastating thing is desupervision. Because it doesn't matter what the rules are if you put people in charge who are committed to not enforcing the rules. And that's what the Clinton administration, followed by the second President Bush, did. And they were actually quite explicit that they hated this intense supervision. They hated the enforcement actions. They hated the prosecutions. for their big strategic alliance was not with business in general, but finance in particular. Finance and high tech and Hollywood were the three big ones in terms of industry, but by far the biggest of them was finance. And indeed, finance funded pretty much entirely the New Democrats' superstructures, their organizations, which are called the Democratic Leadership Council. That was almost entirely funded by big finance.